that people sort of started believing that this is going to be happening forever, right? That these house prices are going to be rising for forever. And houses are a great investment opportunity. And you should just buy one even if you're not going to live in it because it's going to appreciate in value and make you money, right? Once again, we're talking about the US. Is that true? Are houses really that good of an investment opportunity? Over a long historical period of time, let's take 100 years of housing prices, are they really good investment opportunity? What do you think? Yeah. Actually, no. Housing prices appreciate very, very slowly if we exclude this last period of the last, let's say, 7 years. Usually housing prices are very slowly creeping up. So a house is not it's not an investment with the highest expected return. How about that? But that definitely changed over the past couple of years, and people have, well, not couple, but 7. And people usually have very short-term memory, so they figured, okay, well, for the past 5 years, housing prices have been going up, so very likely they're going to be going up at this particular pace forever, so let's invest, and let's buy something we can't afford. Now, these low interest rates weren't the only things that were contributing to this housing bubble. Another one was, once again, politics. For the longest time in the US, home ownership for everyone, or at least for everyone who can afford it, was the societal goal. People in Congress thought that actually, if we give everybody a house, or if everybody can afford the house, our society is going to be happier, and we should work on that. And they, of course, were working on that with the help of these two companies. What are these two companies? Fannie Mae and Freddie Mac. What are those? They're, yes, they're very large, government-backed, which basically means that they can't really default since they're backed by the US government and by the Treasury. So they're very large mortgage companies. Companies that, with their market power, were able to keep those mortgage rates low for extended periods of time by accumulating mortgages from the ground level, from the actual counties and towns where those houses were sold, accumulating those mortgages, pooling them together in financial securities, and selling those financial securities elsewhere. That was their primary, and holding some of them, of course, that was their primary objective of these two. And they've been quite successful doing that for the past several decades, and especially in the recent couple of years, and definitely helped out with the whole housing bubble, because once again, low interest rates, low mortgage rates mean higher demand for housing, and housing prices that go up, or that continue to go up. Now, people were so excited about this whole thing. First of all, you could get a house at a relatively low monthly price, right? And then the prices for those houses kept appreciating, that people just got carried away. And I think I've told those of you who have taken my classes, but there was this ridiculous situation somewhere in California where a gardener from Mexico, who wasn't even a citizen, got a mortgage for a house that cost, how much do you remember? $750,000, right? What were they thinking, right? But that's how this whole bubble was created. People weren't thinking. So let's talk a little bit about what led to it. So, one more thing. Oil was cheap. What do you think that led to? How is oil relevant to housing? What's the big deal there? Yes?
Construction. Like there's more supply of houses, so there's more people that buy houses.
And what does that have to do with oil?
Well, oil drives the industry, all the construction industry, everything is tied into oil.
I guess they could use some oil-based materials, but that wasn't the big thing. What do you think was the big thing? How did cheap oil contribute to this whole housing bubble?
The interest on oil is increases, so they can afford more loans.
More what?
Loans.
Loans. No, it's a very geographically question. Cameraman.
Well, cars use oil. They could just move around and buy houses all over the place.
Yes, they could afford driving for a while to their new big house, right? If you get a house in the city, you don't have to drive. But if you want a big house with a big yard and with a front lawn and all that, you kind of have to move out of the city, right? And the further you go, the cheaper that house gets, or the bigger it gets for the same price. And since gas was cheap, people could afford driving for a couple of hours every day to get to their big house and back to work, or to work and then back to their big house. And then when oil prices started creeping up, and especially getting to where they were last summer, well, no, let's have some of the one before that, summer of 2008, people suddenly realized that their relatively cheap large houses in the country were costing them quite a bit in gas. But that wasn't the main thing. The main thing that drove this whole bubble, other than interest rates, of course, and the government policy, were financial markets, right? If not for financial markets and for pooling of risks that our financial markets got so good at over the past couple of decades, this probably wouldn't be possible, what happened to us, right? But our markets got so good at pooling risks from those low levels to Wall Street and then disseminating those risks to other people and keeping some of them, that this whole system started working pretty well and turning over pretty fast. Now, let's sort of envision this whole process for a second. So you buy a house, you get a mortgage, right? You usually get a mortgage from who? Who originates your mortgage? Your local bank, right? And then that local bank does what with that mortgage? Sends it somewhere, right? Because this local bank doesn't really want all those mortgages in the same area to be on its balance sheet. So where does it send your mortgage? Let's bypass every other intermediary that we can think of, and where does your mortgage end up? On Wall Street, right? And then investment banks on Wall Street do what with your mortgage? And with hundreds of thousands of other mortgages that they have gotten from other banks that did it, local banks that did the same thing? Yes, what did they do?
They package them with products, like mortgage bonds.
They package them into mortgage bonds, yes, and then what do they do with those? Sell them to whoever wants to buy them, right? Whoever wants to take that risk. Now, what is a particular mortgage-backed security that was extremely popular during the pre-crisis period that, a lot of people blame for what we ended up having here? Jordan.
The CDO?
Yes. And CDOs, let's see, I think I have a picture, yeah. So CDOs were pretty complicated things, right? You were pooling thousands of mortgage obligations into one security. Then you were slicing this security into pieces, into tranches, depending on the riskiness of that your client, the client who would be buying this tranche, was willing to accept. The riskiest tranches, by the way, the banks did what with them? The investment banks. They often kept them, right? That's where we're getting all those huge write-downs for Wall Street banks, right? Because the worst part of those big pools of loans, they actually kept oftentimes. So when everything collapsed, they actually ended up with the worst piece of the pie. Why do you think they kept them? Yeah, they could. Probably not all of them, but some of them they definitely could.
You think you can make money on them?
Yeah, you make the most money on the most risky stuff, right? So yeah, the riskier the better if you think you're protected. And they were trying to protect themselves with what? What do you buy to protect yourself from a default on an application that you buy? Pardon?
Insurance.
Yes, and what do we call financial market insurance against default? Yes, and what is a CDS? It's a credit default swap, right? So technically, if you have an obligation that you're worried that someone who actually wrote this obligation may default on, you buy a credit default swap, and now whoever sold you that swap has to worry, and you're sort of protected. And did that work out pretty well for them, these CDSs?
No.
Who did they buy most of those CDSs from? And I'm not saying all of them, but quite a large amount.
AIG.
Yes, and AIG, when this